And with us right here in the studio, Binky Chadha, the chief equity strategist at Deutsche Bank Securities. So Binky, let's start with you. Michael Binger, we just heard from him. He said caution is warranted. He said we could see a potential pullback. You agree?
Our view is basically that, the correction that everybody was calling for looks like it's basically complete. We didn't sort of quite get all the way down to 10%. We got pretty close. Now we're back sort of where we started. And we think one of the hangovers from that correction is, pretty sizable segment of the market has basically remained short or underweight. And we think that, the recovery is for real in the near term. We think the labor market begins to turn. Of course, part of that's just going to be a snapback from the snow, but we think over the next 2 to 3 months, the labor market turns, payrolls turn positive. And so I think we're going to see those underweight and short positions flush. So, we have a call that over the next 2 months, we should actually see 1250 on the S&P. That call I would put in...
So it's about 10% higher, a little bit.
10% higher, but I would put that really in the context of our call for the year, which is 1325. So it's more a call on the timing rather than any change in the direction.
I just want to break out with a report coming on the Lehman Brothers bankruptcy. Breaking news just coming across the terminal right now. The Lehman Brothers examiner finding colorable claims against J.P. Morgan and Citigroup, saying J.P. Morgan and Citi helped cause Lehman illiquidity. According to this report, it's a very interesting statement here, and we're going to get more details on it soon. But in essence, they're coming out and saying that investors could lay claims against Lehman Brothers. So very interesting story there. Let me get back to Binky Chadha and Jessica Hoverson here, talk about the markets while we wait for more details on that. Binky, let me ask you about the volume issue, because I know you think the economy is going to turn around, and I know you think the correction came and went here, but it was on very light volume. Does that, along with the overhang, the underweight overhang that you were talking about, concern you?
Sure. So, the volume issue is, and the fact that, volumes are not as high as they were perhaps around the low when we saw that last year in March, is a source of great angst to the equity markets. But I think, there's 2 points. Number one, it's important to keep in mind that equities as an asset class, U.S. equities, have basically received no inflows despite the 60-70% rally that we've seen. Our call is that the flows will come. But at this point, it's a lot of it. What we're seeing basically is really about positioning. In terms of volumes more generally, I think it's pretty typical at this stage to actually have relatively low volumes.
So it doesn't bother you?
It doesn't bother me, but the call is that the volumes will come.
Binky, what is going to make them come, though? Because even if your outlook is pretty optimistic, as you say, jobs are going to come back, the economy is going to continue to come back, isn't that becoming more and more the consensus? And considering stocks have already rallied some 70% since the lows, isn't all of this optimism pretty much priced into the market at this point?
So I would say first on volumes, the point I was trying to make clear was that, we are still at that stage where I think you described our view pretty correctly, but I would say that there is a whole spectrum of views really out there, and I would say, the average view is relatively uncertain about the recovery, and that is why we're seeing relatively limited participation basically in the equity market recovery, and therefore very limited volumes. In terms of what's in the price, I can see the 70% rally, but it's a question of arithmetic as to where we are in terms of prices relative to earnings. I would argue it's important to keep in mind that basically, Q4 earnings on an annualized basis are already $77. So, the multiple basically on this year's earnings is still about 14. I would argue that's, relatively low by historical standards, where we think it should be closer to 16.5 if the market believed the recovery.
Hey, Binky, I'm going to jump in here. It's Adam out in the newsroom. Is it possible the path of least resistance is up just because people aren't buying into it yet?
I would say the path of least resistance over the next 2 months is up. On our estimates that the market, as a result of the correction, or as a result of anticipating the correction and trading the correction down, some segments of the market have basically been left out in the cold, so to speak, and have basically retained underweights.
You work at a financial institution. Do you agree with Jessica's assessment that a lot of those financials still have shaky balance sheets?
I would say the biggest issue for the equity markets and the financials is really some relief from all of the regulatory uncertainty that basically hangs over the financials. It hangs over healthcare, and historically and today, it is that uncertainty that depresses basically equity multiples, which is really the key here. Our estimate really for corporate America is that today it is holding vast amounts of excess cash. We estimate, for example, that the S&P 500 companies have $1.4 trillion in excess cash. We estimate that the financials are holding $800 to $900 billion in cash.
A lot of
so
cash.
it's very important to get the message through that it is a regulatory uncertainty, and there is more than enough capital there, but it's just going to sit there up and until that uncertainty is released.
I want to ask you, it's only been, I think, a few months that Carol and I had breakfast with you and Joe Lavorgna, and you guys at the time were uber bullish. Joe especially.
It's all relative.
Have you pulled back a little bit? Because it seems like the extreme bulls have pulled in their horns a little bit. John Herman is one example. And the real bears have given that this will be a pretty good couple of months, even first half, for profits and for even the labor picture.
Sure. I mean, we haven't really changed our numbers or our forecasts, which would be one metric by which to measure whether or not we've changed our minds. I think the consensus has moved a lot closer to us. But our basic thesis has been that corporate America overshot on the downside. We are now in the process of an involuntary recovery. Corporates have to expand to meet existing demand. And the necessary condition for the next phase, basically, of the recovery and the expenditure is, the enormous amount of cash that is basically built up on corporate America's balance sheets. And so the necessary condition for that is there. So really no change in views. And to the extent one measures bullishness as out of consensus, I think the consensus has gotten closer to us.